welcome to Indian Open. Good morning, Neeraj.
Morning, Devina. What promises to be another day of pause. At least the start seems to suggest that. But let's wait and watch. We might be in for a surprise or two.
Yeah, I mean, looking at least a few of the brokerages now starting to look more optimistic on the Indian equities. HSBC putting out 40,300 for Sensex by the end of the year.
Yeah, and showing in the way the flows are out as well. I mean, really, the last few days, $2 billion
the month of March itself, the way it started, it's been a really strong month ahead of elections. But Asia is a pocket, while in the green, no big bang moves, aside from the fact that you've got the Nikkei 225 trading up 1%. Shanghai is up 1.5%, and Hang Seng is up about 0.75%. For SGX Nifty, we are trading in the positive territory, but just about 0.2%. So 11,404 is where the SGX is currently trading at. Agam Vakil joins in. Remember, yesterday was the weekly options expiry. You would have seen a bigger number in terms of the turnover. But what transpired and what can we expect as we close out the week? Agam joins in for that.
Well, unwinding is what we've seen actually in the futures and options space, specifically the indices and their respective futures. So a 1% decline in open interest for the Nifty futures and, well, a little larger number, as much as 6.6% decline in open interest for the Nifty banking futures. So unwinding coming through on a day of a pause. The VIX has also come off to a certain extent, still below the mark of 15.5. And in terms of your open interest change, what we've seen is writing around the 11,300 put, which means that we will see a considerable amount of support around 11,100, 200 and 300. Of course, the maximum open interest remaining with the 11,000 put. On the higher end, it is around 11,500. But moving on to stocks then, and or rather the put call ratio, that is at around around 1.68 now, and the Nifty banking put call ratio at around 1.26. We do have some changes in the F&O band. BEML, IDBI Bank in the F&O band, along with Reliance Infra, Reliance Power and Jet Airways. There's a new entrant, and that is Adani Enterprises. So we expect restricted trade there. And in terms of other stocks that we are keeping an eye on is something like a Jubilant FoodWorks, PC Jeweler and Reliance Capital, which has seen a lot of movement of late. And of course, in terms of unwinding, we're also keeping an eye on Apollo Hospitals and BEML. BEML standing out despite the fact that we saw 17% unwinding or decline in open interest. It really hasn't come out of the F&O ban. The question is, should this unwinding continue? Will it move out for Monday? That's a question which will be answered towards the end of the session. But on the whole, consolidation continues and we continue to see mixed cues.
Right, Agam. Thank you so much for that. That's the F&O wrap out as of yesterday's session. Gurmeet Chadha, CEO and co-founder of Complete Circle Consultants, is joining us on the show this morning. Gurmeet, good morning to you. A slight bit of a pause, you might say, for the Indian equities, but nonetheless, the run has been so stellar. The flows, the liquidity that has driven this run up can't be questioned. What's going to be the approach as we move forward towards the key polling season?
So there were actually a couple of triggers to watch for. I think markets right now are pricing in a lot of positives already, in my view, whether it is the political outcome, whether it is interest rate cuts, so I think there are some lot of positive outcomes which are priced in. I think one key trigger to me is the Chinese NPC meet, which is a 2-week long meet, which has started around 5th of this month. I think the downward revision of GDP to 6% kind of a band, I think they will probably defend this 6% far more aggressively than I think what the market thinks. Currently, the sense is that there is a VAT cut of 3% in manufacturing, another 1% in transportation and logistics. There's also some reports of they're reducing the company contribution to social benefits by 3-4%. So I think it would be much larger fiscal package, and that could bring in some broad cheer for the EM index. Also, FIs are no longer overweight India, courtesy a lot of reasons. So they are right now neutral. So you would see now some of the active managers also coming. What we have seen is more passive flows, and that's why you see in the second leg you saw the IndusInd and the HDFCs of the world joining a bit of on the upside, which did not participate earlier. So I think the global liquidity events to be watched out for, including Brexit.
Okay, let's talk about specific stocks then, and one would be in HUL, talks of moderation in growth, volumes about 6 to 7.5%. Most brokerages saying that the weaker macro environment is likely to affect growth for HUL. What would you do with a counter like HUL and the rest of the consumption pack, which somehow has lost flavor in this recent rally in high beta names?
So I think, if you see I think the stock market is the best reflector. If you see, HUL hasn't really, been part of this upside which we have seen, and I think the market was getting a sense that Q4 would be a little soft. Coming from a distribution background, typically Q4 is so soft. It's not that, and obviously they had 4 or 5 very good quarters, but I think the rural volumes still look good. The channel checks suggest that the demand is still robust. Also, we are getting into election season. There are various reports, and in fact, my sense is we could outspend 2014 by 1.5, 2x. I was tracking the official donation sites of a lot of political parties, and the ruling party has probably got 7, 8 times more than the challenging parties. In fact, there are some reports talking of 50 to 60,000 crores of spending happening in election. You add the farm transfer of 28,000 crores, which will happen by March, and then you add some Manrega transfers. You're talking of a lakh crore kind of a consumption boost. So I would not be too. In fact, I would like to add HUL. I think I'll be a little more positive on Nestle. In the sense that their advertisement spend is a 15-year high. Finally, after a long time, they are gaining some market share from Cadbury's and in chocolates. There is improvement in market share in beverage as well. The volumes in prepared dishes also seems to be good. So that is one counter one can look at. Titan also is looking. So I think I'll be a broad buyer in consumption space and not get too deterred by a soft Q4 or slight moderation in growth.
Gurmeet, good morning. Neeraj here. What have you made of the rally that we're seeing in some of the textile names? Indocount, Himmat Singh Aceed, a clutch of other mid-caps textile names are doing very well. Something changing fundamentally in the industry, or more a case of a dead cat bounce?
Neeraj, looks like, would not like to call it a dead cat bounce, but, probably a bit of a catch-up. I think also, one stock which we track, and there is also that figures in a lot of PMSs which we recommend and refer to clients is Arvind. And I think there was some disappointment on the price discovery after the demerger. So that's one pick we are tracking, and I think it's a good story. It's so as I said, consumer staples and low ticket discretionary items I think will do well over next 2 to 3 quarters. So I'll be selectively positive in this space.
Arvind Fashions, right? Not Arvind Limited.
Yeah, Fashions, absolutely.
So you would reckon that Arvind Fashions, because of the lower listing price, is a good stock to enter if you get a chance? The problem is it's not on an upper circuit almost every single day.
Yeah, we got discovered at a very ridiculous price, Neeraj. So I think it's a good long-term buy. It plays the urban consumption as well as the rural aspiration story both. So it's a top pick in a lot of PMSs which we track and refer to clients. So that's one stock we are positive on.
All right, Gurmeet, just stay on with us. Lots more to talk to you about, and then we'll get our technical analyst also in just a few moments. But let's talk about what other stocks are making news. Our research team is here with us. We've got Coal India in focus with regards to yet another interim dividend that they've announced, as well as a cement dealer survey. Nikki and Mishika, both of them are here with us. Mishika, first off to you, some stocks and news.
Yeah, so the first stock we're talking about is Reliance Industries Limited. India Investment Trust is going to buy Mukesh Ambani's privately owned East-West Pipeline Limited for 13,000 crore rupees. RIL will have to offtake at least 22 MMSCMD of gas from the pipeline. If it fails to do so, RIL will be liable to pay the differential amount to pipeline infrastructure. The amount payable by RIL will be the difference between rupees 500 crores per quarter and the actual revenue earned by the pipeline infrastructure. Vedanta's Zambia unit halts copper shaft operations after the contractor fails to secure funds to pay workers. The contractors failed in its efforts to secure funding from banks, as reported newspaper News Digger. ICRA revises rating outlook on 6 PSU banks. Bank of India, Punjab National Bank, Oriental Bank of Commerce and Bank of Maharashtra got an upward rating from negative to stable. Punjab and Sindh Bank got a downward rating from stable to negative, and IDBI Bank was downgraded from developing implications to negative outlook. RBI categorizes IDBI Bank as a private sector bank with effect from January 21st. This move was done upon LIC acquiring 51% of the total equity capital of the bank. Lastly, we have Jubilant FoodWorks. Delhi High Court gives a stay order of National Anti-Profiteering Authority against the company and penalty proceeding, subject to a deposit of rupees 20 crores on Central Consumer Fund. And the bulk deal today is also involving Jubilant FoodWorks. Kotak Mahindra Mutual Fund acquired 8 lakh shares at rupees 1312.4 each. ICICI Prudential AMC acquired 8.2 lakh shares at rupees 1312.4 each. And promoter Jubilant Consumer sold 39.6 lakh shares, which is 3%, at 1312.4 rupees each.
Right, Mishika, thanks very much for that. Those are some stocks you need to keep an eye out on. Coal India, and yet another interim dividend, but the total stacks up to be low.
Yeah, so a second interim dividend announcement of 5.85. Earlier, the company had announced a dividend for around 7.25, which makes the total dividend for this financial year at 13.1, which is still less as compared to what you've seen in the previous financial years. We are just estimating that the futures yesterday and the current market price, the discount between the two is a discount of around 2 rupees, which means that the dividend declaration even after the discounts were trading at a 7.85%, futures were trading at a 7.85% discount as compared to the current market price, and the announcement is for around 5.85, which clearly indicates that this is still 2 rupees short as compared to what the market was estimating. And if you look at the dividend history, if at all the company doesn't declare a final dividend, then this dividend of 13.1 will be the lowest that we've seen in the financial year 2013. What Morgan Stanley typically has to say about this is that the dividend payouts until now have estimated to the tune of around 4,400 crore, and the dividend thus far is 13.1, is lower as compared to the estimates of rupees 19 per share for the complete financial year. However, having said that, they're not ruling out the option of a final dividend coming through, because company right now is sitting with a strong balance sheet situation and a lower payout ratio, which is relatively lower as compared to the previous years. Total cash on books that Coal India has right now is to the amount of around 40,000 odd crore. That is as per the September situation. This is all that we have in terms of Coal India. Right. And if you look at the cement dealer survey for South-based companies, where BOFA has reported that the companies partially around this region have partially rolled back the prices in South India. Ex-Karnataka, the rollback is to the tune of around 10 to 20 per bag across South India. And in Feb, the prices have risen to around 30 to 50 per bag that we saw in, as per the dealer check also, the prices had substantially picked up and there was a momentum coming in. But then they attributed this to two reasons. That is a muted demand seen in some of the regions like Tamil Nadu, Chennai and Hyderabad, and also a labor shortage in the ramp up to the federal election is also expected to weigh on the demand, which in turn may have a bearing in the prices for the next 2 months. So they don't expect the trend to reverse for the next 2 months. Well, in terms of the other region, it's suggested that the companies have failed to push a second hike in West India, and they expect the prices, they've actually surveyed the prices to remain flat in the central region.
Right. Mishika and Nikki, thanks very much for that. So lots of things to keep an eye out on, and before we actually go to our technical experts, Gurmeet, just one word on the cement pack as a whole. We've spoken to a southern-based cement company, and we've spoken to even a Kolkata-based cement company, and they're of the opinion that the prices are stabilizing and they're looking to take price hikes. But the survey is suggesting that the price hikes that have already been taken have been starting to roll back. What's your sense with regards to the turnaround for the industry, particularly now that we're heading into the slightly less peak season when the rainy season kicks in?
So, Devina, I'm overall positive. I really don't believe in playing the geographies in terms of picking up south-based cements and all. I think a pan-India play would be better, like ACC. I think if you see, there is a huge thrust on affordable housing. I think, and I think this thrust is unlikely to be reversed, irrespective of the the government at center. So it's a long-term positive. Also, I think the pain in a lot of the cement stocks was in the price, barring maybe a Shree Cement. So I think from a valuation perspective, it's looking good. So what we like here is also there's a lot of consolidation. You had 10 players earlier, probably, which had 50% market share. Today, Ultratech is 150 million tons out of 500 million tons. So same is the case with steel as well. So you will see now value growth coming. We like ACC. I think that the clinker cement swap was a bit of an issue there. The EBITDA per ton seems to be improving. A lot of cost reduction initiatives there. We also like Shree because of the utilization level of the fuel and the power efficiency they bring to the table. Largely north and east based, predominantly north based. And if you see, they have done very, very high frequency, low magnitude addition, all from internal accruals. And not through debt. So we like those two picks in that space, and overall positive on this space from a medium to long.
Interesting. Actually, just before I get in technicals, if I can, Gurmeet, just one quick word on Coal India. And are you penciling in a third dividend? And if not, what's the impact on the stock likely? Because this dividend, if it's the final dividend, is lower than what the street is working with.
I think it will come, Neeraj, looking at the fiscal stress we have. So I think, best to avoid this space. There's another CPSE ETF tranche coming. You want to play some arbitrage or we had that discussion earlier. You want to do some trading. I think the CPSE ETF is the best route. Enter at a discount or maybe take some exposure to a long short fund and make some trading gains.
Okay. Well, that's apt advice as well. Gurmeet, stay on. So much more to talk about. Let's get in our technical experts on board. Amar Singh of Angel Broking with us on the charts, as well as Jay Bala of Cash the Chaos on the show as well. Good morning to both of you. Thanks so much for joining in. Jay, is there a Nifty trade or an index trade still possible? It looks like it will start with a bit of a pause.
Yeah, good morning, Neeraj. I think at current levels, it may not be that sensible to pull a trade on the Nifty. I would rather prefer a little more a consolidation pullback. It'd be better off buying. That way, you'll be controlling your risk if you buy it a bit more lower. Given the fact that the markets have run up almost to 11,400, it doesn't make that much sense to pull a trade on the Nifty. But if you're a high-risk intraday trader, there's always a trade there. But if you want to take a positional trade, from a 1 to 2 day perspective, I don't think there is a trade here. You would rather wait for the markets to pull to support somewhere closer to 11,120, which was the previous high of 2019. So until that, you don't do anything. But the view on the market is that even when we spoke during the ILFS crisis, I had said the markets are likely for a worst case scenario of 9,700, but record highs to 12,400 was anyway coming in the later part of 2019. The market so far has behaved well, and that market view is well respected. Coming to the banking index, the banking index is much more stronger compared to the Nifty. Obviously, it's at record highs, and it's mainly driven by private sector banks. And the next resistance for the banking index comes in about 29,750. But my price objective for the medium term, the equivalent of 12,400 on the Nifty, is about 33,000 for the banking index. So that's the medium term view. Here too, you might, if you are trying to pull a trade, maybe it's slightly better off trying to pull a trade on the banking index for the day. The supports come in about 27,500. So a pullback, if the markets give you a drop on an intraday basis close to 27,500 on the spot banking index, that might be a place to pull a trade. But here too, you're better off going to individual names. Axis Bank, which we said during the September ILFS crisis that is heading for 750 to 900. It's come to target. It's weakening a bit. HDFC Bank, that has got a fantastic range breakout with a huge thrust in volume. And I don't know if I've said this on this channel. I've said that HDFC Bank is heading for 2,500. So that breakout has already happened. So you might want to view HDFC Bank in a much more bullish fashion. ICICI and Axis Bank have done their part. They're likely to take a backseat at the moment and hand over the baton to HDFC Bank.
Interesting. Amar Singh, what's your thought? And is there a trade that exists on any of the key indices?
Yeah, very good morning. See, what we're witnessing in Nifty over the last couple of trading sessions, that on the upside, it is yesterday, if you look at it made a high of 11 11,383, and then it corrected. But overall, it is forming a very strong base around 11,250, 260 zone. So ideally, if there is any pullback towards those levels, that can be a good level to buy from a short-term perspective. And the stop loss in that case needs to be 11,180. And on the upside, the target could be taken as 11,450, because what we are seeing is that Nifty continues to be extremely strong. Yes, it is now some of the indicators on the hourly charts are also indicating that it is overheated, and there is likely to be some consolidation, which we are witnessing. So with the trend still being strongly in favor of the bulls, I would say any pullback should be used as a buying opportunity. And as far as Bank Nifty is concerned, I would say Bank Nifty also continues to trade extremely firm. Technically, even from a short-term perspective, I would say that it remains stronger than Nifty. But yes, I wouldn't recommend buying at these levels, because for any meaningful correction in Bank Nifty, for an entry somewhere around 28,500, 28,600, so almost 400 points from the current levels, that could be a good level to buy, because the risk-reward ratio in that case would be more appropriate rather than at the current levels.
Okay. We'll come back and talk a little bit more about stocks, but on to our special segment, Bloomberg Edge, by Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock this morning. Yash, what's the stock on your radar today?
Morning, Devina. So actually we're looking at NIIT Tech on the charts, and a sell signal coming on the back of the bearish engulfing pattern. As usual, before we start, let's first try and understand what the bearish engulfing pattern is and how do you interpret it. It is basically the formation of a large red candle right after a after a bullish candle, wherein the body of the second candle completely engulfs the one ahead of it. The larger is the size of the second candle, the higher is the evidence of a top forming. Now coming back to the price chart of NIIT Tech, as you could see, it has been trading in a sideways trend, and it has been meeting with a resistance around the 1350 mark. Note that 1400 is where it has made a lifetime high, and since then over the last actually one and a half month, it has been in a consolidation phase. It has not been able to make a move on the either side, either on the up or on the downside. And what we saw yesterday is that after falling significantly, it has closed very near to its day's low, which indicates that from these levels we could expect some weakness as well. Also on the lower panel, we have the RSI that too is trending downward. So if we could enlarge that, you could see that the RSI too has been giving a downward direction, which indicates that there seems to be persistent weakness as far as NIIT Tech is concerned.
How well has this worked in the past?
So Devina, the bearish engulfing pattern has worked six times right out of the 10 times, out of the 11 times that it has occurred, with the success ratio being close to 3.5% over the next 10 trading sessions.
Right. Okay. Great. Yash, thanks very much for that. That's interesting, because of late we've been seeing the entire IT pocket under some amount of stress, and mid-cap IT names also, not just in NIIT Tech, but an Emphasis has been coming under pressure. Hexaware has been coming under pressure. You've got Mindtree, which is not doing a whole lot much either. So these, all these names have been probably taking a little bit of a back seat in this rally that we've seen. But let's get down to some specific stocks from our technical experts. I'll start off with you, Jay.
Yeah, I have two short calls today. The first is a short on Reliance Capital, and Reliance Capital has been one of the weakest stocks within the markets. And it's in yesterday's session there was an open interest increase of about 15%, and the stock came in really sharply. And all indications point to a print of 166, which to my interpretation says that it at least go and retest the bottom, or maybe the bottom is not in for the stock. So I'm placing a stop above 190 for Reliance Cap and keeping a price objective of 130. If 166 prints, you might even want to be if you would usually trade multiple positions, you might want to leave partially open. You might even go back deeper to close to the 100 mark. And the second is a short on Jet Airways. And Jet Airways, although the bottom may be in what it clocked in October, Indigo is a much better stock within the space, but Jet and Spice look a bit weak. And given that Jet is in the F&O space, this might be an ideal candidate to go short. So hence placing a stop about 255 and expecting it to go somewhere close to the previous swing low of about 205, 202. So that might be the price objective. And a strict stop loss about 255 is necessary.
Okay, so 2 sell calls coming in from Jaybala. Amar Singh, what about your stock ideas?
Yeah, I would say the first one to look at is a buy on Oro Pharma, Aurobindo Pharma. So what we are seeing technically on the charts is that on the long-term charts, the stock is in for consolidation, but with a positive bias. And the intermediate-term trend also, we are seeing that the stock has very strong support, has built a very strong base around 700, 720. Currently, it's around 778, 779 levels. And technically on the short-term charts also, the trend and the momentum has definitely increased and continues to remain strong. So this is one stock one can look at buying anywhere in the range of 773, 775 around the current levels, with a stop loss of 754 and a target of 814 on the upside. And the second stock to look at is Britannia Industries. What we are seeing here is that Britannia continues to remain extremely positive on the long-term charts. Yes, on the monthly charts, we are seeing some consolidation, but the intermediate term as well as the short term clearly indicate that there is further upside momentum to this stock. And if you look at it, it formed a very strong base around 2800 levels, then currently it's around 3150. And even it's breached a key resistance zone because it was unable to breach the 3100 mark for quite some time for many trading sessions, and that has been breached, and it's closing significantly above that level, means almost for 4 successive days. So this is one stock one can look at buying. So any pullback towards 3135, 3140 can be used as a buying opportunity with a stop loss of 3064 and a target of 3276 on the upside.
All right, just to keep in mind, Britannia enters the index Nifty on the 29th of March, and making its exit will be HPCL on the very same day. So both these stocks will be watched out for. Just one word, on Reliance Industries. In keeping it with you, Amar, the last 4 days, I think it's been closer to 7% higher for Reliance Industries, and it's a big heavy weight on the index.
Yeah, we had a buy call in Reliance almost around 1230, 1240 levels. And technically, if you look at this chart, this is one of those stocks which really indicates across different time frames and trends that the trend strength is there. So that specifically means is that any pullback towards major support levels should be used as a buying opportunity. And even if you look at Reliance from a very short-term perspective, the long-term trend definitely remains positive and strong at the same time. The short-term trend has also definitely gained strength. But what we are seeing is that because earlier, if you look at it, Reliance almost had a major resistance zone or a double top somewhere around 1320, 1330 zone. So now that has been taken out. It's closing above that level. So I would say that ideally it should not now start trading below 1320, 1330 level. It's currently on 1341. Trading below that level wouldn't matter much, but closing above that level is something which is very crucial and important. So I would say that still the trend is up, but in the short term on the hourly charts, it's clearly indicating that it's now in overheated territory. So effectively it means that any pullback is possible towards 1320, 1330 levels. So from a short term perspective, if it holds the 1320 levels, one can look at a pullback from there.
Okay, let's wait and watch if that happens. Gurmeet Chadha, one quick thought. Do you track the company Laurus Labs? Amansa has checked into it. The stock was active as well yesterday. Any thoughts here?
No, Neeraj, not in our radar. We don't track this stock.
Okay, so leave that out. But the stock has gained about 15% in the month gone by, and Amansa Holdings has checked into that stock. So do watch out for that. Gurmeet, just quick 30-second view. Is SpiceJet and Jet's loss Indigo's gain? Would you be a buyer in Interglobe Aviation? Quick 30 seconds here.
Tactically, yes, Neeraj, but the joke on the street is that, Indigo has no pilots, Jet and SpiceJet have no planes, and Air India has no passengers. So I think you could be tactical here, but if you want to play aviation purely from a trading call, I think Indigo is the best bet.
Okay. From a trading perspective, though, Indigo is what Gurmeet is betting on. It's up about 13% in the last 1 month, 12.99 on the stock now. We're going to watch out closely for the open. Pre-open will happen any moment from now. Remember, also keeping a track on the currency, which has been going from strength to strength over the last 7 days. So now, yesterday's close was 69.35. Remember, yesterday we spoke to Anant Narayan, and he said that now, as per REIR, valuations slightly look overstretched on the currency, you actually may be slightly more overvalued on the rupee versus the dollar at this rate, 69.35. This is back to, or rather stronger than those levels in the month of August, post which the rupee started to crack. So watch out for that closely, and watch out for the bond yields as well as we open up. That's a pre-open take on your screen. The Nifty 50 flat to marginally positive, and so is the case with the Sensex. Individual counters then, we start pulling it up. Eicher Motors is your top gainer for now. Hero MotoCorp follows that, up 1.5%. NTPC 1.6%. Remember yesterday's buy close, NTPC was the top gainer on the Nifty. It was up, I think, about 2.5 to 3%. Indiabulls Housing 1% higher. Infosys is up as well. You've got Asian Paints up closer to 1%. GAIL has moved up. Tata Motors at 181, that does okay. ONGC is up 0.5%. Ultratech Cement at 4,000, that's up 1% too. Yes Bank at 251, yet another day of green. Grasim, TCS, SBI a 0.25% higher. ITC, L&T and Reliance Industries marginally in the green. Amongst the bigger losers, ICICI Bank 2.5% under. Tata Steel, Adani Ports, Bharti Infratel, Bajaj Finserv are some of the bigger losers, but just about 0.5% in terms of the quantum of the cut that's coming in. On the rupee, more strength building up. From 69.35, we were at 69.27. So another, 0.1% gain coming in on the currency. For the bond market yields, that should come up 7.36. So fluctuating between 7.35 and 7.37.
Okay, let's look at Laurus Labs. Since I have it at the top of my mind, let's just see what that stock is up to. Not too much. Had a bit of a rally yesterday, but let's wait and watch if this rises further. If something is happening with Indocount, but I'm at a loss to understand what. We tried to contact the management to come and give us an interaction. They don't want to talk right now. The stock is on a roll, a serious roll. The 7-day move, if it goes up another 10%, is 83%. That's quite stunning, really, for a stock. But yep, that stock is doing extremely well for itself. Himmat Singha Seed too, by the way, is not doing too badly for itself, up another 3%. We'll talk to our technical experts. We spoke to Gurmeet about it, but we'll talk to our technical experts about if there are some further upsides out here or no. There's some strength in eClerx services in the session today. Do watch out for that one. DLF was up 2 days on a trot. Let's see if it's continuing its merry moves in the green, at least starting off in the green, which is pretty good. And India Cements and Ramco Cements, since the Bank of America Merrill Lynch survey suggests that there's some price rollback that's happened in the southern companies. Don't quite know if the stocks are reacting. No, not much. Ramco Cements, by the way, I think when the note came out from one of the brokerages was at 640. It's marched on to 700 almost effortlessly. India Cements is at 101. When the management spoke to us, it was at 86. So even that one has just marched on quite effortlessly. And lastly, just want to see what Interglobe Aviation is up to. Is it gaining further? It's had half-decent days the last 1 or 2, starting off marginally in the green. So these are some stocks that we'll monitor. Let's first get in, before we move back to our guest, Samit Sarkar, who joins us with the key brokerage calls of the day. Samit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is TTK Prestige, where CLSA has downgraded the counter to sell from buy, but have maintained the target price at 9,000 rupees. Now, the brokerage has downgraded the counter as it believes that the valuations have now adequately factored in all the possible growth triggers in future. Now, it sees a limited scope for further earnings surprise going forward, as the large capacities that will come on stream in financial year 2020 would be initially focused on relatively lower margin export orders for TTK Prestige. So no earnings surprise going forward according to the brokerage. According to CLSA, the company's EPS is expected to grow at a CAGR of around 18% over FY18 to FY21, which has been factored in the current share price of the company. Second note we have is on Gujarat State Petronet, where HDFC Securities has initiated a coverage with a buy rating and a target price of 207. Now the brokerage is expecting strong volume boost because of the upcoming LNG terminals in India. Now it is expecting Gujarat State Petronet's total volume to grow at a compounded annual growth growth rate of 3.4% over FY18 to FY23. Now, Gujarat, according to the brokerage, Gujarat has a high potential for CNG, and the brokerage believes that because of this, the company's investment in the city gas distribution will strongly pay off in future. Lastly, it says that the company is likely to remain in sweet spot with rising free cash flow, which will in turn reduce the company's net debt to close to 400 crore rupees by FY23 from current 2,700 crore rupees in FY18.
All right, Somit, thanks very much for that. Currency is improving even more, so now 69.23 from 69.27 at the start of the session, so going from strength to strength of the rupee. That probably wouldn't augur too well for the IT companies, which have anyway been in a slump over the last few days, not participating in this move that we've been seeing. You know, the smaller ones as well, so you've got to emphasize your Mindtree, Hexaware, NIIT Tech. All of them, the last few days, have been slightly more muted. Today's session, not much of a reaction that you're seeing. All of them are up in trade today. IT is a pocket, Gurmeet. Come in on this.
Yeah, so Devina, I think this is a bit of a, because of the rupee appreciation, there is some bit of pressure on both frontline and mid-cap names. What we like in this space, in the pecking order right now, is Tech Mahindra. I think if you see the numbers which have come in, the telecom vertical grew almost 2.5%. You know, the enterprise business was up 4%. Amongst various segments, if you see the BPO did quite well. The digital business grew more than 33%. The deal win momentum is good. Good, you know, on-site utilizations and cost efficiencies as well. So we are positive, and I think the telecom grew more because of the 4G services. The 5G is yet to kick in. So that would be the, and I think if you can have, you know, you had 2-3 good quarters, and you know, quality companies, when they consistently deliver good quarters is when they get re-rated. Apologies. So top pick will be Tech Mahindra, followed by Infosys in that space. Positive on IT, you know, on a medium to long term.
Okay. Positive on IT, a medium to long term. For the short term, these stocks have had a bit of a grind. Devin Choksi of KR Choksi Securities also joins us in this conversation. Devin, good having you. Thanks for joining in. I wanted to start off with your thoughts on what's happening to the oil marketing companies, Devin, because while this CPSE ETF news has brought on a bit about a technical pullback, they've been on a bit of a roll the last few days despite crude inching up. Are they pricing in something, or are you sensing something that we are not out here? And what would your recommendation be on these stocks to anybody who's looking to maybe buy or sell them?
Yeah, good morning, Neeraj. Well, according to me, nothing has changed fundamentally as far as the business and the outlook of the business is concerned. 2-3 things which has possibly increased the stock prices. So one is, of course, I think the liquidity coming in through the ETF side, which is basically definitely resulting into the buying which is available at a level which the stocks are available at a level at which I think probably downside is limited. So I think certainly in order to make the gain out of their short-term liquid money, the ETFs are basically putting money into the areas where they see the opportunity, and I think this oil PSUs, they give that kind of an opportunity. Also at the same time, I think the dividend declaration season, as I call it, I think for the public sector companies, because the government wants to receive money in the books. So obviously I think that is another area which is helping most of the companies to find the follow-up buying coming from the areas. I don't think any other fundamental factors have changed, and neither I would like to think that things are likely to change immediately for any of the oil PSU companies. We will be keenly waiting for, I think, the consolidation exercise which is happening or underway for HPCL. I think once that exercise gets over, probably we'll see how exactly the BPCL and other companies, I think, consolidates. But from that point of view, I think I would feel that oil marketing companies currently are adequately priced. Maybe some headroom, some upside in between. I think it's possible. It's more of a momentum driven for the time being. I don't know, I think, whether one should participate immediately into this momentum driven. I for one would believe that when the market gives opportunity of this magnitude, where the growth in the fundamentals are shaping up and happening very fast, some of the quality companies from the long-term investment perspective should be bought into the portfolios.
Okay, and we'll talk about these companies post 9:15 as well. Devin, just one quick thought though. Do you track the textile space? I haven't got a smart enough or got a good enough reason from almost anybody, and I don't blame guests for the kind of moves that happen in Indo count. In the last 1 month, the stock has gained 114%. Last 7 days, 80%. What's happening here?
Honestly, no idea, Neeraj. I think not tracking it enough, so won't be able to give any kind of comments.
Yeah, but as I said, it's just difficult to blame anybody. Just that the stocks have had a rollicking move the last few days. Maybe we'll ask our technical experts about this, these stocks as well. It's difficult to quite get a sense of what's happening. The managements are not talking, not a sector that is well tracked for right reasons, but doing well. Anyways, we'll talk to our technical experts in moments from now. Since we are just 5 minutes away from market open, let's tell our viewers all that they need to know to stay ahead in trade today. First up, Coal India continues to reward its shareholders. The second interim dividend of 5.85 rupees has taken the total year count to 13.10 rupees per share. Morgan Stanley expects chances of one more dividend announcement. The stock a couple of % lower, pricing in the difference between spot and futures.
Analysts expect Hindustan Unilever's growth to moderate in the fourth quarter. Project volume growth in the range of 6 to 7.5%.
HSBC has reaffirmed its overweight stance on India. Its latest report has a Sensex target of 40,300 from a December 2019 perspective.
In key bulk deals, Mansa Holding acquires over 3% stake in Laurus Labs at 351 rupees per share, while FIL Capital Management offloaded 5.7% stake at the same price.
And in key brokerage calls, CLSA downgrades TTK Prestige on high valuations, while Nomura has downgraded BHEL on a weak outlook.
And South Indian cement companies like India Cements and Ramco Cements may correct in trade today, as the Bank of America Merrill Lynch survey suggests a possible rollback in prices. Just about 3.5 minutes left to go now, and since we were on the topic of Indo count and the move thereof, whether or not our technical experts can weigh in on this, let's go across to Jay Bala. Jay, I mean, it's 80% up in the last 7 days. I don't know whether or not you can actually look at an entry here.
Definitely not an entry here, and it's also high risk given that it's basically, if you look at it from a long-term perspective, it's gone from 250 to 30. So this could be just a correction to that kind of a steep decline. The stock is probably not put in the bottom. So, but if you are even trying to pull a trade here, you're definitely better off pulling getting into a correction rather than buying it at such elevated levels. You definitely, it's not going to go to record highs from here, and even if it were to go to record highs, it's not going to be one way. So all things point to avoiding it or waiting for a pullback to come through.
All right, and if you see the last 2 years chart, it's just a tiny blip that's coming from where it actually traded at. So like Jay Bala pointed out, a very risky trade to take. Indo count there at 68.5. About 2.5 minutes left to go for market open. And, Amar, just come in on NTPC, because while this is being an index stock which has really not done much, say in the last 3 months or the last 1 year for shareholders, the last 10 to 12 days have not been bad. It's been constantly in and out of the top position of the gainers on the index.
Yeah, that's correct. Because if you look at around 14th of February, from almost 128 levels, it made a high of 160. That's on 11th, and currently it's consolidating around 153 odd levels. So what is actually happening here is that the stock had corrected from almost 185 levels, coming the way down to 128. So this is more of short covering and also buying around these levels, because if you look at the stock from a very long-term perspective, around 125, 120, 130, that's a very strong support zone for NTPC, because these were the levels which were last seen in somewhere around, I would say, on the lower side, 115, 120 levels were seen around February 2016. And the recent low that was made was around 128. So I would say slightly off from those levels. But yes, so this was more of short covering. I would say sustaining is the key for NTPC, whether it's able to sustain above 160 odd levels, because then only it could lead to some further upside, or we could see some consolidation in the stock, and the stock trading between 160 and again short term I would say 130. So that could be the range. Taking out 160 could lead the stock towards 174, 175 levels, because that's the next, I would say, resistance zone, which was in September 2018. We saw a top around those levels.
All right. 50 seconds, quick top calls, 10 seconds each. Jay, first to you.
Yeah, I would go with a long on Federal Mogul Goats. It's a cash stock breaking out, and I would expect the stock to go to 640 and place a stop below 500.
So 100 odd rupees higher from here. What about you, Amar Singh?
I would say one can look at going long in Grasim around 824-25 levels. That's a good level to buy. And with a stop loss of 797 and a target of 875 in the short term.
Okay, Jay Bala as well as Amar Singh. Gentlemen, thank you so much for taking the time out and being with us today and giving us your thoughts. Appreciate your time. Federal Mogul Goats, that's the stock that I think Jay Bala recommended. Let's wait and watch what happens there. Markets start off well, about 0.25% higher for the Sensex, the Nifty Bank 0.5%. So banks continue to surge ahead, at least on the opening ticks. Let's wait and watch if these last. The mid cap and the small cap indices should next come up on your screen, and let's see what's happening there. We're a tick of green out there too. So good start for the mid cap and the small cap indices. The breadth should be positive. Now let's get the heat map up on the screen and see what's moving and what's not. So, well, a fair degree of green, very little red. Coal India, 1.5% lower. Remember, the futures were trading at a substantial discount, pricing in maybe a slightly better dividend. It's coming slightly lower than what people were working with. Maybe that's why this small downtick. Let's wait and watch if this extends itself. But aside of that, don't see too much else which has corrected too much, meaningfully. What's gain? Is it only Tech Mahindra, or has IT shown a bit of spunk this morning? Well, TCS marginally higher, HCL Tech marginally higher. So IT is not in the list of losers, which is not a bad thing. Indiabulls Housing is up, Yes Bank is up, so both of those continue to move up. Bharti Infra about 1.5%. But aside of that, it's a quiet move from a stock-specific perspective, just that the Nifty and the Nifty Bank 0.7% higher. So the indices are the ones to monitor. 0.5% for these two, and the Nifty Bank really piling on the gains. 200 points higher for the Nifty Bank right now. Just quickly, the intraday of the Nifty Bank, if you can pull up, because it's really started off very well, taken off. It was a quiet day yesterday. The previous 2 days were very, very strong, and now it's starting off on a really good note, the Nifty Bank. So that's that one index to monitor. Look at that start, really smart start. Let's see if we build on from here. Very quickly, 2 or 3 trend makers that I want to point out, yesterday's movers, etc., before we hand it over to Devina for what's happening across the broader end of the spectrum. Firstly, some of the key stocks on an uptrend, and Indo count continues to rise and shine, about 5% higher. Laurus Labs another 1.5%, so good going there. And DLF maybe taking a bit of a breather, but in the green nevertheless. These are the 3 stocks that have been on an uptrend for the last 2 or 3 sessions. So good start to the trading day again for them. DLF now marginally in the red. Aviation stocks in focus, and all 3 start off quiet, though I must say SpiceJet in the green, which is nice, because otherwise everybody anticipated SpiceJet and Jet to correct and Interglobe Aviation to gain. Which brings me to my next set of stocks, the cement companies from South India. The Merrill Lynch survey, Bank of Merrill Lynch survey suggests the price rollback in South India, and both of these stocks starting off slightly weak in the session today. What are you spotting, Devina?
I highlighted it, but I'll give you one guess as to what's at the top of the list of the Nifty 500. Yeah, it is the top gainer, and like I said, you already highlighted it, 6.5% higher. Religare follows that, 5% higher, and then you've got a Jaycorp, you've got a V-Guard that's up 3.5%. Persistent Systems is up 2.7%. Jindal Stainless 2.5% higher. Everready Industries 2.5%. Manpasand Beverages took a breather yesterday from the big up move that it had been seeing. Today back in the green, 3% for Manpasand Beverages. This stock too in the last 1 month has been up 60%. Inox Wind, that 75 is up 2.5%. SJVN moves up in today's session, so that's got about 2% gains odd coming in for the counter. Indiabulls Ventures, then you got Future Consumer, Coffee Day, all up 1%. First Solutions, Glenmark Pharma, RBL Bank, REC, these are all the gains that you're seeing in trade this morning. The breadth of the market is more positive yet again, so 800 stocks are advancing versus a dip of just around 300 stocks. Losers, Shrey Infra is down 3%, Reliance Infra is down 1.9%, sorry. India Cements down 1.3%, Sterlite Tech, that loses more ground. You've got PC Jewelers at 85, it's looking weak. HCL Info, United Bank, Voltas, Marico, and Adani Power are some of the other losers. DLF, the last few days had actually had a good run. Today sees some profit taking, about 0.25% or so.
Yeah, Devina, interesting. Just one mover that I want to highlight from the IT space, Persistent Systems. So it's a price which surprises me, not that it's a rollicking move, but when the rest of the IT pack has corrected, this one up 2.5%, but over the last 7 days is what I mean to say. The last 7 days, Persistent has actually gained about 3.5–4%. The last 1 month, about 7% gains. So it's not had
very persistent move.
Yeah, it's not had a bad move for sure. When the rest of the IT pack has corrected a little bit, so that's an interesting mover in the session today as well. But Reliance Infra, after the 4% downtick yesterday, another 2%, despite selling off or looking to sell off one of its assets in order to pare down debt, it doesn't quite help the stock. Nevertheless, our two fundamental experts are still with us. Gurmeet, I want to come to you first on Ujjivan and Equitas. Now, the RBI governor yesterday said that he's going to meet the small finance banks because they're an integral part of the financial inclusion scheme. You know, despite the setbacks that they had with regards to the promoter shareholding and otherwise, I was looking at Ujjivan, 7 days, 1 month, 3 months. The performance has been pretty strong when the other NBFCs have been all over the place. What's your view here, Ujjivan and Equitas?
Neeraj, very good business model. I think despite the business they are in, the asset quality, the kind of controls, I was fortunate to meet some of the people in one of the interactions, and I'm very impressed. I think Ujjivan really looks good. Also, one thing which I think is a trigger now for this beaten down, Ujjivan not beaten down, Equitas is what got other NBFCs got correction, is this new liquidity tool by RBI. I think what this will do is this will bring down the shorter end yields, and that is bringing down cost of capital. And I think once the short-term yields come down with more effective transmission, I think it will be very positive for some of the lenders in particular. So I'm actually positive, beginning to get positive on some of the beaten down NBFCs name. I might just want to wait for a week or two more and maybe possibly wait out for the RBI policy. But good time to look at some of these names, including Ujjivan, including some of the names like Mahindra, M&M, Shriram Transport. Some of this could be some of the good names to get into.
Deven, the other set of names, and yesterday I think Westlife's move got our attention squarely on that. Jubilant FoodWorks features today in the HSBC Global Research list of the top 16 stocks to own in India. While HUL may have given a commentary which was of moderation on a sequential basis, these QSR names, Jubilant, Westlife, I don't know if you look at that, the third one as well, but if you look at this pocket, what are your views on these two?
Well, I think in general, Neeraj, I think what we find is that I think it's an interesting place, except that I think the efforts which are required to bring them into the profits, the QSR restaurants, I think is little bit more challenging. And given the fact that I think there is a increased demand for consumer preferences, but at the same time I think the preferences keeps on changing, I think it is all and more becoming very challenging. So unless I think you have a very dedicated focus on this particular segment of business, which in some of the cases we find with the promoters, I think probably you will not be able to make the best out of the opportunity out here. Honestly, I think we don't have coverage on any of these companies, so won't be able to give any specific idea about a particular company or a group of companies. But I do believe that I think the space remains challenging. At the same time, I think those who have dedicated presence out there with differentiated brands, probably I think they could probably have a reasonably good chance to succeed vis-a-vis I think one of players in this space.
Right. Devin, while we're talking about some of these pockets which have in a way not provided any shareholder return over the last few months, or so to speak, one pocket has been telecom. Last few days you've just seen like a Bharti Airtel move up the way it has. But aside from that, is there any meaningful change that you anticipate within the telecom space for the likes of a Vodafone Idea as well, which has been bleeding shareholder value up until now?
See, my own understanding on the subject is that unless and until the current telcos offload the assets, heavy assets which are there in the balance sheet, they will not be able to make the best out of the opportunity that they have in front of them. The opportunity in front of them is a higher amount of data consumption. Opportunity in front of them is that I think the converting the consumer into the larger consuming customer as far as I think the data aspect goes, and 5G is around the corner. So from a perspective of looking at I think the current telcos, I would think that the fiber and the tower infrastructure which they are nurturing in their books and against which I think they are carrying significant amount of debt, it has to get off the books. If it doesn't get off the books, then probably I think you are going to bleed, you are going to ask for more capital, and the return on capital ratios will continue to remain poor. Currently, Bharti is, I think, repairing the balance sheet, inviting more amount of capital, promoters are contributing, other shareholders are contributing. So from that perspective, balance sheet will get repaired. But when I start looking at deployment of funds, the deployments of funds are once again going in building the hard infrastructure, the tower and the fiber infrastructure. And to me, I think it's not a winning game. Tower and the fiber infrastructure are best suitable to the players, I think, which are basically invest IT kind of players who are putting money into infrastructure and generate IRR rate of return. So from that perspective, I guess I think the current telcos probably will have to relook at how they hold assets in their balance sheet and generate business. Our strong view is on Jio. Jio is trying to do that by way of offloading or monetizing the fiber and the tower assets. And on the other side, I think they are going to pump more amount of content and consumption of the data, which will probably drive the value and the valuations both for the company like Jio. Bharti and Vodafone Idea, they are probably at least 2 or 3 years behind Jio, at least at this point of time. So would safely avoid, I think, those companies. Even though they are going up, I think I would not be interested in buying them into the portfolios.
Right. What have you made out of the euphoria surrounding banks of late? A bank Nifty now already past 29,200. Key performers and key contributors being all your private sector banks, HDFC, Axis, IndusInd, even Yes Bank.
So the private sector and the corporate banks, probably I think they are working on the monetization drive. The kind of vertical that they have created within their setup, NBFC verticals, insurance verticals, even some of the other bank product verticals, I think that they have created, AMC verticals. All these verticals are expected to find some amount of monetization at given point of time. I think HDFC is the one which has already started monetizing and listing those companies separately. So from a perspective of looking at Kotak for that matter, I think could be the next in line. Even you have the HDFC Bank having the one of the largest NBFC in their portfolio. Somewhere down the line the monetization could happen. So that is one thing which we keenly follow. We feel that I think some of these companies over a period of time I think would start monetizing the assets that they have built into their balance sheet. So that is one aspect. The second aspect is more importantly the digital reach is making the difference. Many of these banks are learned to adopt the blockchain technology, through which I think they would be probably managing the risk on one side better, and at the same time expand their reach out to the consumer with a relatively more amount of effectiveness, and cross-selling of the products would happen thereafter. So I think dynamic processes are getting built through this blockchain kind of adoption which they are talking about. So that is where I think some of the private sector or corporate banks are interestingly positioned. They are giving relatively better perspective about the future growth program that they have vis-a-vis the public sector banks. So that is the reason for which I think the money has started chasing them. At the same time, I think in this market you require somewhere the growth to be visible, and I think these banks are giving the visibility of growth. So again, I think the another reason for money going into this space.
Gurmeet, what are you banking on in the next 6 months to 1 year?
So, I think banking clearly is a consensus view. With what I think one thing we've missed out is, if you see this 59-minute portal, in fact, we keep talking of fintech. Probably this is the biggest fintech, application which is around. Last I checked, and I was with Nilesh on this, is that 30,000 crores have been sanctioned and about 24,000 crores has been disbursed. Now that's a staggering number. Also, what my sense is, and a story which you guys also covered, is the share in the deposits. I think there is a clear gain of market share happening in private banks. And mind you, when you lose market share in current accounts, then you lose cash management, you lose corporate loan book, you lose trade, you lose FX, you lose significant fee income. So I think the private corporate banks clearly will do well. 6 to 12 months, maybe SBI or BOB will also probably figure in. In fact, I'm bullish on consumption names. I'm bullish on even TTK Prestige despite a run up. I think there's a big story waiting to unfold, and I'll probably be a holder in the stock for maybe 3 to 5 years. Positive on Titan as well. It's just 5% market share in a $45 billion industry. They are launching some amazing products in the jewelry, whether it's the wedding collections, studded collections. They're going at the lower end as well, which is with Nia, which is at maybe 13, 15, 16 carat jewelry, catering to both mid and high end. Their eyewear business, which is just about 7% right now, could be a material contributor going forward, both offline and online formats. So consumption names, I'm very, very positive. I think despite valuations being stretched, you will see more and more money being chased, and elections being and the farm transfer being the biggest drivers.
All right. We'd love to carry on this conversation, but we're done on time. Devin as well as Gurmeet, thank you so very much for being with us this morning and sharing your thoughts with us on the platform. For the Nifty, we're above 11,400. A really smart move early Friday morning. Hopefully, we can end the week on a big bang note as well. The banks are looking even stronger at 29,266. Time for a very short break on Indian Open. When we return, we get you ICRA's view after the rating agency revised the outlook for 6 PSU banks. And we will discuss the trends in the telecom industry and the road ahead for the sector with Rajiv Sharma, co-head of research at SBI Securities.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Back with Indian Open right here on Bloomberg Quint, and look at the Nifty Bank. 363 points up in the green now, 1.25%. It's the last 7 days or the last 10-day rally in the Nifty Bank is quite unlike anything that we've seen in at least the last 6 or 7 odd months. 6% up for the Nifty Bank. That's a remarkable move on the Nifty Bank. I mean, it's probably a bit more in the last 10 days as well, but the surge has happened in this week for sure. It's the hero of the rally the last of this week, and since March, I mean the month of March has been quite exceptional for the Nifty Bank, and now you can simply correlate the two together. What's happening to FI flows and thereby what's happening to Nifty Bank. It's a no-brainer, but it just continues and it keeps on pulling the indices along with it. Boy, we're just a few 100 points away from all-time highs for the Nifty as well, so this is very, very interesting. Speaking of banks though, rating agency ICRA expects better asset quality, solvency levels and earnings for some PSU banks as well in FY20. 5 of them to be precise. As a result, they have upgraded some of the ratings to stable from negative. Bank of India, OBC, Punjab National Bank and Bank of Maharashtra are these upgraded banks. Let's discuss the rationale behind the same. Joining us is Anil Gupta, the VP of Financial Sector Ratings at ICRA. Anil, good having you. Thanks much for joining in. What's the base assumption for these upgrades, that the GNPAs will come down and the overall sector is improving? Why is it that you've given this upgrade in the first place?
Yeah, thank you, Neeraj, for inviting me on the show. If we look at our estimates, like first of all, I'll talk about the ratings. We have revised the rating on 4 public sector banks from negative to stable. But even after having changed the outlook on 4 banks from negative to stable, we still continue to have 8 out of 21 public sector banks on negative outlook. So it's not about a simple paintbrush, like we are just equating all banks after the massive capital infusion which the government has done in 2 banks, because still we believe that public sector banks, not all of them will be in a position to make profits, though the overall sector will be profitable. So as per our estimates, depending on how the asset quality and the credit provisioning pans out, we expect that in a stress case scenario, 10 banks can continue to make losses even in financial year 20, as against almost around 16 banks which are expected to make losses in financial year 19. So it's not in general bullishness, but if you look at the trajectory of the profitability from a loss of almost a 70,000 crores loss which the banks are going to report in financial year 19, the profitability estimate across all the 21 public sector banks is estimated at around 30 to 35,000 crores for the next financial year, and it is very minuscule in relation to the net worth of these banks. So the net worth of these banks is upwards of 6 lakh crores, and in relation to that, a 30,000 crore of profit translates into a mere return on equity of around 4 to 5%. So it's not a very significant turnaround in their profitabilities. But if you look at in absolute terms, after 4 consecutive years of losses, they will return back to the path of profitability. For the last 4 years, from financial year 16 to financial year 19, the banks have been reporting, public sector banks have been reporting losses. And coming back to the rating action, like 4 banks where we have taken a rating action, these are banks which have also exited PCA. 4 banks, 3 banks out of the 4 banks, like Bank of Maharashtra, Bank of India, Oriental Bank of Commerce, are the 3 banks out of 4 where we have revised the outlook to from negative to stable. And Punjab National Bank, where we had a negative outlook, again there we have revised the outlook to stable, primarily because the threat of the capital breaches which were there for this bank is now mitigated after the sizable capital infusion which Government of India has done in this bank. On the other 2 banks, where we have not only taken a action in terms of revising the outlooks from negative to stable. In fact, one of the banks we have also revised our outlook to negative, which is Bandhan Bank, largely because if you look at the losses which the bank has done and the slippages which the bank has made in the 9 months. So the capital allocation to this bank has not been commensurate to the quantum of slippages as well as the loss which this bank has done and expected to make in financial year 19. So in this case, because the commensurate to a rating level, the capital cushion have weakened. So this will remain above the rating regulatory capital requirements, but the capital cushions have weakened after the losses and no capital infusion which this bank has done.
Okay. For IDBI Bank, even after LIC coming in, will there still be pressure due to credit provisioning? Just wondering what's the call that you've taken here?
So apart from the Government of India, which infused sizable capital, LIC has also infused sizable capital into IDBI Bank of around 21,000 crores. But as per our estimates, because of the high level of NPAs, the large portion of the capital will go into the loss provisioning on these NPAs, because recovery has not been to the extent the way it was expected from these NPA accounts. In fact, as per our estimate, though the bank will not breach the regulatory capital ratios next year because of the large capital infusion, but in case of the ability to reduce its net NPA, come out of the PCA framework, that will remain a challenge for the bank, because even after a sizable capital infusion, the net NPAs continue to remain in double digits. And as per our estimate, if the bank has to really come out of the PCA, they will require around 5,000 to 6,000 crores of capital, for which they have an option of divesting their non-core assets and as well as raising fresh capital from the markets. So pending that capital raise, because now today RBI has also classified this bank as a private bank, so we really need to see the way the bank is able to raise this capital, because capital is sizable in relation to its size and requirement and the profitability or the outlook on profitability which is there on this bank.
Is the rating action for Bank of India, OBC or Bank of Maharashtra driven by the fact that they are now out of the PCA framework, and therefore there could be a pickup in credit growth for these banks and hence a structural change for all of them?
Yeah, yes, you are right. So one is basically they are coming out of the PCA, but also we should see the solvency, which is the net NPA or unprovided NPAs against the net worth of these banks. So after the government has infused the sizable capital, these banks have been able to provide heavily onto their NPAs and reduce their net NPAs below a 6% level, which has supported their exit from PCA also. So as a bank, their solvency ratios, unprovided losses have been recognized upfront. They have been accelerated because the capital infusion was sizable, and now these banks can stop worrying in terms of the PCA inclusion, and now go back to the path of growing their loan books. Possibly they will exercise due control in terms of going back to maybe concentrated or large exposures, and those things we need to see. But again, when we look at these banks, these rating of some of these banks remain at the lowest level. From the lowest level of the rating, their outlooks have been revised from negative to stable. So even after a stable outlook, they continue to remain rated at one of the lowest levels among the various public sector banks. And the future trajectory will be dependent on how they do in terms of their future asset creations, like what sort of loans they give, quality of those loans, and so as per our estimate, these banks, despite exiting the PCA, they will still require growth capital next year and the regulatory capital also. So they will not breach the capital ratios as such, but if they have to grow, they need fresh capital next year. So despite a stable outlook, the ratings are at a much lower level, I would say.
Again, one of the theses that I think I read in one of the notes that you guys shared was that the PSU bank deposit share is going to rise and private banks will slow down. Yeah, so I think after last 2 years, it has been an easy run for the private banks, at least on the asset side. So they have been able to, because these public sector banks were out of competition. So definitely they have been able to garner the market share on the asset side. But in the process, what has happened is their dependence on the bulk deposits, because your core deposit has a natural pace of growth. So your franchisee gets developed overnight. You have to really work hard over the years to develop your retail franchise. And the deposits you can accelerate by mobilizing bulk deposits, typically, which can also come at a higher cost in a tight liquidity scenario. Now, when these private banks, when the public sector banks were out of growth, in a growth mode, they were not there for last 2-3 years. The competition for deposit was also relatively limited because these banks were not chasing the deposits. So what we expect is now there will be heightened competition from the public sector banks also, because they will also now get into the lending space. So they will also need to mobilize some amount of deposits, and the competition will go up. In terms of really denting on the core depositor base of the public sector banks by private sector banks, yes, there have been some cases where the banks have been able to offer, they have been offering higher rates on their savings as well as their term deposits. To some extent, there has been a migration of the retail deposit, but it's not very significant.
So retail depositor base continues to remain good. If you look at some of the public sector banks, their YOY deposit growth in their saving accounts itself is upwards of 10%. So it's not a cakewalk for, I'll say, the private banks to get dent into the deposit franchise of the public sector banks, and that remains a unique advantage for the public sector banks, not only in terms of the availability of the funds, but also in terms of cost of funds. So cost of funds also, the private banks continue, the public sector banks continue to remain much better because of their relatively, you can say, a higher share of retail deposits, which tends to be sticky and not very rate sensitive if in a shorter term. In a longer term, yes, rate difference can really make a difference in terms of moving the customer base. So we have to see this, how it pans out maybe over the next 1 or 2 years, because there will be a heightened competition, and possibly the cost of funds, cost of deposits, we think it should go up. And in terms of lending rate, it is difficult to reduce your lending rates when your deposits don't go down.
Okay, Anil, we'll leave it at that. Thank you so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time. Well, some of the PSU banks, the ratings have been upgraded, and predominantly because they're out of the PCA framework, but some of the other factors weighing in as well. IDBI, they haven't done that. Remember, the government has now classified IDBI as a private bank too. So multiple things happening across that PSU banking space. But while we speak about that, the private banking space is on a roll, as we said, 400 points up now for the Nifty Bank, and that's pulling the markets along with it. But this is a remarkable rally, 29,325 on the Nifty Bank.
And no signs of fatigue. The last few days, except for yesterday when it was slightly more muted. On an intraday basis, the last 5 days, if you take a look at Bank Nifty, the intraday swing has just been one way. There's no tussle between bulls and bears. There's no signs of structural fatigue on the Bank Nifty. So it's just a clear glide up, 400 odd points in today's session. Early morning trade, that too. So let's see whether this sustains or no. One other space that needs attention is the telecom space. Indian telecom operators are finally coming to terms with the disruption caused by Reliance Jio. Most have now taken a conscious decision to guard high-value customers and shed off low-value clients. And that's where technology comes in. Jio is now on track to roll out 5G services, while older players like Airtel and Vodafone Idea rather strengthen their 4G services first. So has Indian telecom, a sector which is always focused on client additions, come of age? Let's ask Rajiv Sharma, co-head of research at SBI Cap Securities. Rajiv, good morning to you. And 5G, according to you and your recent note, is going to be the single largest catalyst for the telecom space in the upcoming future.
Yes, hi, good morning. So the way to look at it is that both Vodafone and Bharti have planned a rights issue of 5 billion each. That's 10 billion. If you add to this the Africa IPO of Bharti, the perpetual bond, the potential tower monetization, that's all going to add up to $16 billion. Now, most of this is going to get into 4G spectrum capacity build-up by the incumbent telcos, because they've got roughly 180 to 250 kind of subscribers who are on 2G, and they need to migrate that on 4G. So the combined capacity which they will put up is more than 450 million subscribers if they were to put all this 15-16 billion into their networks. Now, where's the 4G market today? It's 400 million. And we are a 750, 800 kind of unique subs market. So you are adding 450 in a 400 market. So what will be left for Jio from a 9 to 12 or a 12 to 15 months perspective? And Jio has not only been a tech leader in the telecom space with a pure, unique, single 4G network, because others have a hybrid network. He's also been a thought leader. And we believe that they will look at this development very critically, and they will, take a step ahead and roll out 5G. So we believe that the auctions will happen early next year. There may be a couple of times when auctions, there's no take-up and the price is correct for the spectrum. But early next year is the 5G auctions, and roll out by end of next year, which means that India, unlike 4G, we lagged 3 years versus China, will be very close to China on 5G.
But what does that do to prices then? Because obviously you're going to see a tweak in prices once the additional capex comes in, once the rollout of 5G happens. So that's going to be built into the system, right?
Yes, that's a very fair point, and exactly what we have suggested in the report, that post 5G auctions and before 5G rollout, you're going to see a very firm, significant and decisive tariff increase. So everybody's, even incumbents are hoping that now it's all about when Jio will raise tariff. It's not about when Jio will raise tariff, what will lead Jio to raise tariffs. And it is the 5G launch. Because today the 4G service is not priced at the fair value. They were priced with the notion that Jio was entering a 13 or 10 player market and it had to take market share. Plus it was a voice market. Data as a category had not evolved. Now when it comes to 5G, Jio will have to revisit the prices to ensure that the longer term business makes an IRR. And once you have rolled out a new category of service, it's very difficult to raise tariffs then, at a later stage. And from a regulatory perspective also, if you've paid a lot in the auctions, it's easy to take that tariff hike before services roll out.
So how much are you factoring in terms of price hikes? If you're saying that the rollout will happen next year, second half, how much of an increment can we anticipate in the run-up to the rollout?
So we believe a 15 to 20%, or I would say on a higher side, a 20% tariff increase is very likely.
Okay. What happens to the industry structure as a whole in terms of consolidation, in terms of those few big players making their foothold stronger and the entire structure of the industry changing?
Just to follow up to that, Devina, I think the note suggests, and he's saying that the industry may move to a conclusive market structure with two private players. So that's the interesting point that I
so that was coming to in terms of the structure and the number
I think so what has happened is that today, despite a stretched balance sheet, Vodafone Idea have been able to repair that a little bit with both A, the rights issue, assuming it goes through all fine, and B, the operational synergies, the merger related synergies at the OPEX level. But will it be enough for them to go and participate in 5G? And if you look at their 4G capacity addition strategy, it's focused. It's focused in 10, 12 markets. It's focused in the CBDs. It's not pan-India. So they are a pan-India 2G operator, but they are moving to more kind of quasi-regional 4G operator. And when it comes to 5G, it's very important that how good your 4G network is. Because 5G is all about densification. And that's why we believe that we'll move to a very decisive market structure, because currently it's like 3, and let's say if Jio was to delay 5G rollout by another 3 years, then we'll always be 3, and that's something the challenger has accepted. But if this rollout happens early next year, then you are to a very conclusive market structure. And not only that, the regulators always have the tendency to issue new licenses in spectrum at any stage. Even you can look at developed markets like Singapore or Japan or any other market. That can happen any point of time. But moment the telcos have moved to 5G, it's a significant entry barrier, and make that regulatory exercise just a theoretical exercise.
Okay. Now, since you're talking about significant capex that is lined up in order to get going with 5G, what does that do, and does that put significant pressure on our ROEs? And the other part of the equation is Bharti, for one, even Jio to an extent, they're looking to monetize assets and to pare down debt, because they have a big debt on their balance sheet. So while we're talking about increasing capex to make sure that we have our treasure chest ready for the rollout of 5G, what happens to the angle where you're looking at bringing down your debt?
Yeah. So Bharti was, Bharti's got a relatively better balance sheet than Vodafone Idea. We believe that there was no need for them to raise as much as 5 billion in the rights issue. But this is with the thought that 5G is coming and we need to participate in that. That's what, our thought process is. So it's not, I don't think anyone should be building that capex intensity will decline, because even 4G capex is lot to do. And the incremental part is only this spectrum auctions, where you just pay 50% upfront and rest is paid over 15 years. and that can get taken care of with a price increase. So while there will be a one-time capex, but there will be a price increase, but it only goes to the guys who really go and participate in 5G.
So what happens to ROEs?
So ROEs, maybe for first 2 years when you have these auctions, again dip a little bit. But the industry structure, how the analysts will look at the terminal value, given that now there will be only two and there is no scope for anyone else to get in, and new line of revenue streams coming in. Very gradual, which will be IoT, machine-to-machine communications, many things which you can do with 5G. So I think the outlook will improve once the industry structure is conclusive and once that tariff hike has been taken. Then capex will not be so much of a worry.
Okay, so just within the industry itself, talk about from an investor perspective. Right now, what would the approach be if you had to take a call on a Bharti, or if you have to take a play on Jio via Reliance? Would it be too early to step in, wait for things to materialize a bit and then take a call on these stocks, or you can just be a participant from day one?
So we upgraded Bharti in this report. We don't have a cover on RIL, but we believe that Jio should trade at significant premium to EV EBITDA versus Bharti. So 70-80% premium, whatever. So Bharti's 8x, it should command a premium because it's got a big chunk of investments in fixed line, which is not yet translated into revenues, the fiber to home. But yeah, Bharti's already re-rated a little bit in the last few trading sessions post the right issue announcement. So it's kind of fairly valued at these levels unless this whole 5G catalyst was to play out. We've downgraded Infratel. And 5G means more capex, so it's interesting. We don't find value in Infratel because there will be revenue pressures on Vodafone Idea in our view, and that will translate into more tenancy pressures at Infratel. And we believe that at some point of time, the Infratel tower assets and the Jio tower assets will need to combine in a post-5G scenario. Standalone, there is no operating leverage, and it's difficult for them to, because Infratel gets only tenancies from Bharti in a post-5G scenario, and Jio tower assets only from Jio. So they will, and towers are valuable. It's just the structure which needs to change to derive this operating leverage or multiple tenancies.
But that still doesn't expect. Why would you believe that the Bharti Infratel then is a sell? Even if the merger is to happen, we don't know the valuations right now, and you yourself said that the demand for tower assets will be high. Yeah, but whenever these mergers happen, when it's operator-driven mergers, you never know whether there is value creation for minority shareholders, and by that time it happens, there will be the more and more revenue market share declines happen at Vodafone Idea. The Infratel stock also is directly correlated to that. So you don't like the uncertainty with Bharti Infratel? Absolutely. The medium-term visibility is not there.
You've completely sidelined Vodafone Idea.
No, it's not. So, it is like this. If this scenario which we are painting, if this doesn't play out, and let's say there is a delay in 5G rollout by 2-3 years for whatever reasons, then I think there will be so 25% revenue market share is what we see them reaching to from current 32. That's the stop loss. That's where it stops, and then they could gradually come back in the game. But if they have to participate in another big capex upgrade, that's where we are worried about.
Okay, got that. An interesting conversation. Rajiv, thanks very much for joining, and appreciate you taking out the time. Quick word on the telecom space thereof. Well, with that, it's a wrap on the note that the markets are looking extremely buoyant. 80 points up on the Nifty. Banks 450 now, so going from strength to strength. It's a goodbye from Neeraj, myself, and the entire team that's put this show together. Coming up next is the F&O Show.